Yes, Bismillahirrahmanirrahim. Hello and Assalamu alaikum to everyone. Welcome to MA. Welcome to MA Practice to Pass webinar, which is being organized by ACCA Pakistan for June 2021 exams. This is day 4, 20th May, and I am your tutor Haris Hanif, and this is my WhatsApp number. First of all, I would like to make sure whether my voice and screen is all clear. Am I audible and my screen is all clear to all of you? Okay, that's good. That's good. That's great. So this is day 4, and today's agenda is about the performance measurement. See that this was my day-wise plan. We had covered budgeting, we had covered project appraisal, we had covered standard costing and variances yesterday, and today, day 4, 20th May, the agenda is the performance measurement. And what is the importance of performance measurement? That is one OTQ worth 10 marks at least, and maybe few MCQs would have been could be examined from this section. So this particular area of your syllabus is also the important thing, as I have told you that these are the areas which will cover at least 30% of your exam content. In addition, you will be receiving many MCQs on variances, budgeting, on this and this as well. So this is one of the important and the core area which we are going to cover today, performance measurement. So I'm now going to start the topic of performance measurement, and majority of the contents of this area is the theoretical discussion, and it also includes the calculative element like ratio analysis and ROI and RI calculations. Yes, but majority of the contents are theoretical in nature. And in order to answer the theoretical questions, you people should have a broad mindset. You should have a long-term thinking perspective from the side of the organization. So along with the topic, I will be explaining that how to increase your mindset in order to perform such kind of questions, in order to deal with such kind of questions, topic of performance measurement. And one thing is very important I would like to mention here, that performance measurement, you are studying currently paper MA, management accounting, F2. Then you will be moving to paper PM, performance management, that is F5. This section will be acting as a core area and at least 20% in F5 from the examining perspective. This is basically the backbone of the management studies. As I also do teach paper PM as well. I also do teach paper PM, as I have mentioned here, that I also teach paper PM, AA, AAA, MA, and particular this particular area, performance measurement, is the core area as always in the costing and the management accounting subjects. So it was a very brief introduction about the agenda which we are going to cover it today, that is the performance measurement. So now let's move on to the topical slides. This is day 4, 20th May, and let's start. So this is the performance measurement. This is the performance measurement section. And now I am going to start this section, performance measurement. See, what do you mean by that, exactly by the term performance measurement? What do you mean by the term performance measurement? What is performance measurement? See, performance measurement, it actually means that you are assessing the past performance of your organization. Which performance? Past performance. Performance measurement means it involves assessment of the past performance of the organization, the past performance. Okay, now the question comes here, why to assess the performance? Why you are assessing performance? Why and how? These are two different things. First of all, you are assessing the performance. You are assessing the performance of the organization. You are assessing the performance of the organization, and you are assessing the past performance. Now, the very good question is that whatever activity you are, whatever activity you are doing, whatever activity you are doing, you should know the reason that why you are actually doing that thing. So why you are analyzing the performance of the organization. Okay. Okay. Why you are actually analyzing the performance of the organization? The answer is that we are analyzing the performance. Why? To assess the past, to assess the past, and to take reasonable actions, to take actions for the future. To take actions for future. To take actions, I should use the word take reasonable actions for the future. I should take the reasonable actions for the future. Why? Because based on the past performance, that is the feedback, we are making plan, control, and decision making for the future. That what happened in the past, how to improve my performance. I must have to analyze myself that what I had done in the past. So if anything was wrong in the past or was not up to the standard, so I should take reasonable actions in order to improve my performance for the future. So reasonable actions to improve the future performance. Reasonable actions to improve the future performance. Okay. And one more important thing is that this was basically the reason to assess the performance. And how is basically, how will you assess the performance? The simple answer is using KPIs. I mean to say through KPIs. Through KPIs. And what is KPI? KPI means key performance indicators. Key performance indicators. Now, what do you mean exactly by the term key performance indicators? I should write here that anything which you notice, and you will be reaching at a conclusion whether the performance is good or not. Anything which you notice, that is the key performance indicator. For example, you are noticing that a company is making a high profit, so the profit is the KPI. What is KPI? KPI means factors which are noticed. Factors which are noticed. Factors which are what? Which are noticed in order to assess the performance. Factors which are noticed in order to assess the performance. Okay. So how to assess the performance? The answer is through or we can say using what? KPIs, that is the key performance indicator. Next. Now here are KPIs, key performance indicators. Key performance indicators. Remember that there are two kinds of KPIs. Number one is the financial KPI and number two is the non-financial KPI. Number one is the financial KPI and number two is the non-financial KPI. Number one is the financial KPI, and number two is the non-financial KPI. Okay. Now, see that what do you mean by the term financial KPIs and the non-financial KPIs? The financial KPIs means financial ratios. Financial ratios. In next slides, I will be explaining financial ratios like your profitability ratio, profitable ratio, like your liquidity ratio, etc. I will be covering the financial ratios in my upcoming slides in this today's agenda. But first of all, we should have a look on the non-financial KPI, and non-financial KPI is of it's very important. Non-financial KPI is very important. Why? Because non-financial will ultimately hit your financial aspects. Financial means something which is measured in the form of monetary values, in the form of monetary, and that is non-monetary. And that is what? That is non-monetary, non-financial. For example, you are selling a product, and the customer is basically concerned with the quality of the product or services which you are delivering. So the quality does matter. The quality is not the financial aspect, it is the non-financial aspect, because the quality is not being measured in the form of the money, in the form of the dollars. It is a non-financial, but yes, it will have an impact on the financial aspect later on, sometimes in the future. So this is the quality. It does not mean that quality of the tangible product. It quite may be possible that quality of the services as well. For example, the service of your internet. For example, I am teaching, that's a teaching quality. The webinar hosted by the ACCA Pakistan, that is a technical quality. There may be many things of the quality of the product or the services. Number one is the quality, and the next is the delivery time. These are the examples. Delivery time, yes. For example, you ordered a product through the xyz.com from an online store, and it gave you the time period of 4 days to for that parcel to be delivered at your doorstep, but it was delivered 2 days later. So as a customer, you will not be ranking that organization as good. You will be ranking either 2-star or 3-star, that they are not good in their delivery time. So delivery time is the non-financial. It's a non-financial. It's a non-monetary delivery time. IT support system. Yes, IT support system from your organization. For example, you are logging to the website of a company, and the website is not able to handle the bulk of the traffic over it. So there may be the problem over the IT system. Sales return. Sales return means units that are being returned. Units that are being returned. Okay, there is sales return, and that's the units. Obviously, it will leave the footprints on the financial impact, on the financial aspect. But yet sales return, because why the customer will be making the sales as return? Because the customer is not satisfied with the quality of the product or the services. So it may be possible that it may be sales return. And yeah, there is no sales return concept in the service organization, but units which can be returned. Number of complaints. Yes, number of complaints. Customer waiting time. Customer waiting time. For example, you are going to the restaurant and you ordered a meal, sorry. It's my repeated words, goods or services, so that's fine. It's a slip of tongue. For example, you went to the restaurant and you ordered a meal, and they gave you the time, the waiting time for 15 minutes, for example. And the meal is being served to you after 30 minutes. So it's a waiting time. Similarly, waiting time like in a call center. Yes, it's a waiting time. Staff behavior. Staff behavior is also the very important factor. For example, you are visiting a restaurant, and there are many things to be noticed in a restaurant, whether the performance is up to the mark or not. And one of the important factors is the staff behavior as well, because the behavior counts. Behavior counts by the staff, by the customers as well. Way of answering on phone calls. Wastage rates. Yes, wastage rates. Idle time rates. Rejection rates. cleanliness, think of a restaurant, satisfaction of the staff. These all are the non-financial aspects of the performance which are being noticed, which are being noticed. And then you are able to say whether the performance is good or not. And then you are able to say whether the performance is good or not. Okay, so these are few non-financial KPIs, and there are many more. Now moving to the next slide is that financial KPIs and non-financial KPIs. See that this slide is blank. It is left blank intentionally because I have to write something. Financial KPIs, that is monetary. Non-financial KPIs, that is non-monetary. Okay, financial KPIs, financial figures can be manipulated easily. Financial figures can be manipulated easily. It can be manipulated easily, and here manipulation is not easy, non-financial, because we cannot change the reviews of the customer which they have left on our website. All the way we can hide, but we cannot change it, we cannot manipulate it. Not easy to manipulate, not easy to manipulate, not easy. So remember one thing, when something which can be manipulated easily, that means that have a short-term perspective. So remember one thing, financial KPIs are always short-term and non-financials are long-term. Non-financials are long-term. Why? Because non-financial has ultimate impact over the financial. Non-financial has ultimate impact over the financial. Yes, non-financial will be ultimately leaving the impact on the financial. Okay, non-financial will ultimately be leaving the impact over the financial, over a long term. So remember that non-financial is a long term, and when something is a long term, I am writing something with a black color, that when something is a long term, when something is a long term, so that will be showing the broader aspects. Means widest, very broad aspect of the organization. When something is long term, so that means many of the contents will be covered in the long term aspects. Okay, next I would like to mention something for non-financial, that is financial is over, something now for the non-financial. For example, I'm saying that in 2009 and in 2010, the wastage was 20 kilograms and the wastage was 30 kilograms wastage. Can you people tell me in the chat box, must tell me, okay, must tell me 2010 whether the performance is good or bad. In 2010 the performance is good or bad. The wastage was 10 kilograms and then the wastage was 30 kilograms. Was it good or bad? Come on students, do answer me. Make the session interactive. Students are saying that the performance is bad, but I can say the performance is not bad, the performance is not good. Sir, do not judge like that way. Don't judge through figures. Don't judge through figures. There's a very famous quote that do not judge a book through its cover page. So do not judge a person from its first quality. Do not judge the performance through the first figures. Do not judge through figures. Why? Must, and I should use the word always calculate percentage, ratio, percentage. Why? Because percentage will give you the comparison. Percentage will give the comparison. So, Sir Harris, this is incomplete information. Now I'm going to give you the full information that input was 1000 kilograms. Input was, no, I'm not making it 1000, I'm making it 500 kilograms. The input was 500 kilograms. That means something out of something. If I can say that 20 kilograms were wasted, so we do not need to calculate the waste, we need to calculate wastage rate. Rate means percentage. So 20 over 500 is giving me 4%. That means my 4% material was wasted. 4% material was wasted. Okay. And here the input was 1000 kilograms. And we need to again calculate the percentage, that is 30 over 1000. That is giving me 3%. 3% waste. Now in the last year, the waste was 4%, the wastage was 4%, and here 3%. So the waste is reducing. No, waste nahi. No waste. Wastage rate percentage. Wastage rate is reducing and performance is good. And performance is getting improved. All right, the performance is getting improved. So must always calculate the percent. And remember one thing, there's a very importance of the non-financial aspect, because non-financial is a long term. It is showing the broader picture of your organization. And in order to measure the performance, you do not need to see the figures. You must have to calculate the ratios. You must have to calculate what? Ratios, because ratio will give you the fair comparison. So we cannot say, we should not judge through the first impression. We should use the deep analysis in order to conclude whether the performance is good or not. Okay. So I am giving you only 15 to 20 seconds window. If you people want to note anything or take the screenshot, you are allowed to do so. Then I will be proceeding for the next slide. Okay, now I am moving towards the next slide. And oh, we have MCQ right now. That's good. Question: why? It's asking why. Why means reason. Why would a company want to encourage the use of non-financial performance indicator? Can you people read the option and answer me in the question box? The first option is eliminated because non-financial is a long term. To enable the to be easily manipulated, no. Yes, B is the correct, to look at the fuller picture of the business, because non-financial is showing the broader aspect. Non-financial is showing the broader aspect. So Noted. This is the B. And you people have the slides in your in the soft copy. This had been shared in this webinar as well. Okay, to look at the fuller picture of the business. Now, this is the financial ratios. Okay, I forgot to discuss the last option. It was to prevent the goal congruence. No, it is to encourage the goal congruence. It's not preventing. Non-financial is actually the encouraging the goal congruence. Goal congruence means win-win situation for two concerned parties. Win-win situation for the two concerned parties. And if non-financial is important, that means any two concerned parties, it may be company and the customer, it may be company and the employee, it may be company and the shareholders, whatever the two parties, the concerned parties are. So non-financial is basically promoting the goal congruence. It's not preventing, it's promoting the goal congruence. Okay. So non-financial promotes goal congruence. It is not preventing, it promotes, because non-financial is a important area. Okay, students, now we are going to discuss the financial ratios. And financial ratios are, there are four categories. Number one, profitability ratio. Number two is the liquidity ratio. Number three, working capital. And number four, gearing. So first of all, I am here for the profitability ratios. I'm here for the profitability ratios. Profitability. Now, when I will be measuring the profitability ratio, so I will be having many ratios. Number one is the gross profit margin, that's percentage. GP, gross profit percentage, is calculated as gross profit over sales. And how will you calculate the gross profit? That is sales, for example, 1500. That is COGS, that is cost of goods sold, and that was $850, for example. Now you got gross profit. Now you got the gross profit, that is 1500 minus 850, that is $650. So you need to calculate the gross profit in terms of sale. That will be 650 over 1500 multiplied by 100. So the gross profit is 650 over 1500, that is 43.3% gross profit margin. That is the gross profit margin. Okay. Next is my net profit margin. Now, what do you mean by the term net profit? There are many kinds of profits. First of all, you will be having sales. Let's say, for example, it is 2200. You are having COGS, whatever the figure is. Then you will be having gross profit, whatever the figure is. Then you will be deducting operational expenses. So the profit would be, let's say, for example, it's 500, and that is profit before interest and tax. That is profit before interest and tax. And then you need to deduct interest and tax. But we will be taking PBIT, because PBIT, profit before interest and tax, that is profit before interest and tax. Now, why I had not calculated the interest and tax? Because these are the operational expenses. These are the operating expenses, and we need operating profit. So PBIT is also called as operating profit. What operating profit? That is 500 and 2200. So I need to calculate the ratio of net profit margin. That is $500 divided by $2200 multiplied by 100. 500 divided by 2200 multiplied by 100. That is giving me 22.7%. Gross profit? No, it's a net profit. The net profit comes after deducting the operating expenses, and that means it is the operating profit. That means it is the operating profit. Now, moving for the next slide, that is the assets. That is the asset turnover rate. That is the asset turnover rate. Now, what is asset turnover rate? What is asset turnover rate? Here, the asset is basically showing. Here, the asset is basically showing your capital, your capital, and turnover is the sales turnover. Turnover is the sales turnover, as you know that this is the sales turnover. So this is a rate. This is not a percent, not percent. It is a rate. It is a rate. This is a rate. So it is calculated as sales over capital. It is calculated as sales over capital. This is a rate. Okay, this is a rate. Now, how can I interpret this? How can I interpret this sales upon capital employed? How will I interpret this? Let's say, for example, I'm writing a random figure. I'm writing some random figures in order to better understand that, for example, your sales is, for example, your sale is, let's say, 180, and your capital was, let's say, 90. No, not make it 90. Let's say your capital was 70. Okay. So when you divide by sales divided by capital, 180 over 70. So that is giving me the answer 2.57. That's my answer. Now, there is a question in your mind. I know there is a question in your mind. That's what this figure shows. Whatever the answer is, you will be writing like that way. 2.57, your answer, colon $1. And remember one thing, that $1 is always constant. $1 is always constant, and it is showing capital, and this is showing sales. Now the interpretation of this, that against every $1 investment, focus on my word, against every $1 investment capital, the company is generating 2.57 sales, and this is a very good sign. That is, for every $1 invested, the company is generating $2.57 sales, and that is the interpretation of this 2.57. Okay, asset turnover. And asset turnover, it means what? It means, we can say that asset turnover, that how well the assets are used to generate sales. How well assets are used to generate what? Sales. how well assets are used to generate sales. This is basically the asset turnover rate. Asset turnover rate means how well your assets are being used. It's not only required to calculate the answer, you should also be able to interpret the answer, that what actually this ratio is giving me the message. Now next, return on capital employed. Return on capital employed. Return on capital employed means what's your return? What's your return against the capital? And return here, it is showing PBIT. PBIT. For example, your profit before interest and tax was, let's say, 350, and let's say your capital was, 2000 multiplied by 100. Now what do you mean by this terminology? 350 upon 2000, that means you are generating 17.5% profit against your capital. That means how much profit is made, against the capital invested. And remember one thing, you cannot assess the performance until and unless you will be comparing the figures. 17.5. And one thing is that this 17.5% is your return, and we should compare this ROCE with the current borrowing rate in the market. Now, what do you mean by the term current borrowing rate? The current borrowing rate means interest. The current borrowing rate means interest. Borrowing rate, interest. For example, that I am earning 17.5% return, and what if the bank is giving me a 15% return? So that means I am better than the bank. We are better. Because we have generated more than the market interest rate. And what if the bank will be giving me 20% return? This is the open market rate, for example. So that's my performance is not up to the standard. My ROCE should be greater than the current borrowing rate in the market, and that will be the symbol of the good performance. That reported ROCE should be greater than the market interest. And that will be the good performance. This is something to be noted, that ROCE, it is the product of. ROCE is the product of. Product means multiple of net profit margin and asset turnover. Now, how it is a product? Asset turnover, that is net profit is calculated as PBIT upon sales multiplied by. How to calculate asset turnover? Asset turnover, as you had calculated a slide back, that is sales upon capital. And following the very basic mathematical trick, sale is cancelled, and so ROCE is PBIT upon capital. So if any figure is missing and unknown, you can use this trick in order to calculate the missing figure, if any. Through this format, you will be able to calculate the missing figure if there is any missing figure in the question. So also note this thing, and also note this thing as well, that if your reported ROC is more than your market interest, that means you are performing very well, because there is an open opportunity in the market to have a return. So our reported return should be more than the market interest rate. and the market interested in it is easy to collect the data from the central bank, for example, or from the open banks. Now, moving to the next, that is the return on equity. That is return on equity. That is return on equity. Equity here means ordinary shares. It does not mean any other class of share. It means ordinary shares. Mr. Shalan, have you understand the goal congruence? Sorry, I saw the question right now. Shalan, had you got that? Goal congruence, that is a win-win situation between two parties. Sushila, the handouts are attached in this GoToWebinar, and I have also sent this handout in the WhatsApp group which I have created. You can contact here. Shahlan Amir, have you got that goal congruence? Okay, now proceeding for the return on equity, ROE, that is the return on equity. First of all, I would like to make clear that there are two classes of shares basically. Shares. Number one is the ordinary shares, and second is the preference shares. Preference shares, ordinary and preference. Preference means that is the priority. Priority, that means first to settle interest, and then we are at last to give dividend. Ordinary shares. Now, for example, there's a formula, there's a net income and the ordinary shares. Return on equity, that is showing that how much net income, that is how much net income is available. How much net income is available for the ordinary shares. For the ordinary shares. Okay. Now let's say, for example, there was a profit. Let's say, for example, there was a profit of let's say the profit of 120,000. There was a profit, and you have to less. First, you have to less the interest of preference shares, because as its name implies that it is a preference shares. We have to give it a priority. Interest of preference shares, and the interest was, let's say, for example, it was 30,000. So that means 120 minus 30. That means 120 minus 30. That is giving me $90,000. And this 90,000 is basically my net income. This is my net income for the ordinary shares. This is my net income for the ordinary shares. Okay. Now, for example, ordinary shares. For example, ordinary shareholders. Ordinary shareholders invested total $400,000. Ordinary shares invested total $400,000. Now you have got two figures. Number one is the net income for shareholders and the total investment. So ROE would be calculated as 90,000 divided by 400,000 multiplied by 100. ROE 90 divided by 400 multiplied by 100. That is giving me 22.5% ROE. That is the return on equity. Equity here means ordinary shares. Equity here means ordinary shares. Now, moving towards the next slide, and that is the concept of divisional performance. That is the concept of divisional performance. That what is a division? First of all, I would like to explain that what division actually is. But see that head office. Head office is basically assessing the performance of a division. Is assessing the head office is assessing the performance of a division. And what do you mean by the term division? What do you mean by the term division? Division is something which is on different locations, and not all, but maximum authorities are decentralized. Maximum authorities are decentralized, which means that division is taking their own decisions, which means divisions are taking their own decisions. Divisions are taking their own decisions, okay? Divisions are taking their own decisions without the involvement of the head office. Without the involvement of the head office. They are taking their own decisions. That means a decentralized element. And and two important KPIs are used when head office assess the performance of a division. Head office use two KPIs. I need to say that there are two important KPIs in order to evaluate the performance of a division. Number one is ROCE, which you already know, and number two is RI. RI means residual income. RI means residual income. RI means residual income. Now, in the next slide, there is a formula of ROCE and RI, residual income, and there is a terminology cost of capital. There is a terminology cost of capital. I had already explained the overview of cost of capital in my day 2 of this webinar series, in which we had discussed the project appraisal techniques, and I have explained it very well, the concept of cost of capital. So, but again, here I should write cost of capital. Cost of capital means the interest, which is not the interest on the routine activity, which is just the interest of that amount which you have borrowed from someone, for example. That means interest to acquire capital. Interest to acquire capital. Okay. Now, here you can see that the formula return on capital employed, that is profit before interest and tax. That is profit before interest and tax divided by capital multiplied by 100. We know this format. And we need to understand the term residual income. Residual income, and this is return on capital employed. How to calculate the residual income? That is profit before interest and tax minus imputed or notional interest. That is capital multiplied by the term cost of capital, and you get residual income. For example, if I can say that my capital is, it's not something which is a routine interest. It is the capital which we had acquired, from third parties. For example, the capital amount is 400,000, and the cost of capital was, let's say, 12%. For example, the cost of the capital was 12%, and my divisional PBIT was $53,000. Okay, was 53,000. So how I will be calculating the residual income? That is profit before interest and tax, 53,000 less imputed interest, that is 400 multiplied by 12%, and that is 48,000. Now 48,000 will be paying to the finance providers. 48,000 will be paid to the finance providers, and I will be left with 5,000, and that 5,000 is basically the residual income for the division. Residual income for the division. Then, and if I will be using these figures for the ROCE calculation, that is profit before interest and tax was 53,000 divided by capital was 400,000. 53 upon 400, that is 13.25. 13.25 is your interest. Now, point to be noted is that while calculating ROCE, the interest of finance provider was not considered. But while calculating RI, finance provider interest was considered, that was $48,000. So while calculating ROCE, the interest of finance providers was ignored, and while calculating RI, the interest of finance providers are considered, as well as own residual interest. So we can say that RI is a Goal congruent is a goal congruent KPI to assess performance. That is a win-win situation. But you can see, you can say that ROCE only looks at own performance. Only looks at own performance. That is, you can say dysfunctional behavior. Dysfunctional behavior means only thinking of yourself. That is self benefit. Dysfunctional behavior means only self benefit. And if I am considering that how much amount shall I return to the finance provider and what would be the residual amount remaining with me, so that means I am focusing on a win-win situation. So that is why RI is said to be a goal congruent KPI to assess the performance, and it is that dysfunctional behavior, dysfunctional KPI, because you are only thinking for your self benefit. So which one is better? RI is more better, and that could be the theoretical assessment, that which KPI is better, and the reason is that RI is superior. Now, again, this slide left blank intentionally. Which profit figure will you calculate? Which profit figure will you take? The answer is operating profit. And operating profit means PBIT, profit before interest and tax. And capital figure, capital figure, capital figure usually given. If not given, then calculate. If not given, then you have to calculate. Then how to calculate the capital figure? The capital figure can be calculated through two ways. Capital is equal to total assets minus current liability, or 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 capital figure can be calculated as equity plus NCL. And don't worry, there's the same answer. There is the same answer. Capital is equal to total asset minus current liability, and capital is equal to equity plus non-current liability. If the capital figure is not given, then you need to calculate it by using these format. This is one of the general acceptable way to calculate the capital figure, that is total asset minus current liability. Total assets minus current liability. Okay, now there's a PBIT, operating profit. PBIT means same, operating profit. Now I'm going for the next question, and the next question is very interesting. Why? Because you are having an extract of balance sheet, you are having an extract of income statement, and obviously this is profit before tax. No, we will be taking operating profit 500, yes, and the requirement is to calculate the residual income. The requirement is to calculate the residual income. How will I calculate the residual income? Number one, I need to take profit before interest and tax, and here we go, $500. The next step would be to deduct imputed interest. And how will you calculate the imputed interest? That is capital. And capital come from where? That is total assets 3400 and current liabilities 1000. And these are long-term borrowings and the divisional equity. So capital would be calculated like that way. We have to deduct it. Capital is equal to total assets 3400 minus current liability 1000. So my capital is 3400 minus 1000, that is 2400, the simple calculation. So imputed interest is calculated as capital, which is 2400 multiplied by cost of capital. Now see that there are two interests. Number one is the cost of capital 11% and long-term loan is 9%. We will not be taking 9%, no, because this is only of bank and cost of capital is 11%. 11% is the complete cost of capital. Is all cost of capital from all the finance providers, not just bank. Remember, I had taught this cost of capital, the cost of capital concept in my day 2 of this webinar series, which you can see the recording to understand the cost of capital, the concept which I had given. There's the complete cost of capital from all the finance provider, not just bank. But this 9% is only of bank, okay? So we will be taking 11% here. 2400, 11% equals 264. And that is my residual income. RI. And that is 236. The division is having 236 residual income. It was an interesting question and completely exam focused. Hurry up, do copy this. I'm giving you 15 seconds window. Now the time comes to have a feedback on this residual income. Understood this concept? Excuse me, students, just drop your feedback regarding this question, regarding this residual income. Have you got this? Okay, that's good. Now we are moving towards the next question. And again, the next question is an MCQ standard. And that is the question, what is the return on investment to the whole number? You are required to calculate the return on investment. I would like all of you to read this question at your own pace first, then afterwards I will be reading and then I will be solving. A division has a residual income of 50,000. That's RI. And the net profit before imputed interest, that is obviously PBIT. it was 80,000. If it uses a discount rate 10% for computing imputed interest, it's invested capital. What is the return on investment? Okay, sure. Remember one thing, whenever the question is in the reversal format, just write the format of that thing which is given in the question. And here it is given residual income. So now I am using the format of residual income, that is PBIT, and the PBIT was $50. Sorry, it was it was residual income, right? PBIT was 80,000. Okay, the PBIT was 80,000, and then I have to deduct imputed interest. And where is the capital? No, I do not have the capital. Multiply cost of capital. Yes, I have cost of capital, and the answer would be missing. The capital is unknown to me, so I am not writing anything. This is 10%. Okay, this is 10%, and my residual income was 50,000. So taking the difference, it would become 30,000. 30,000. So if I will be dividing 30,000 with 10%, that is, now here capital multiplied by 10% is equal to $30,000. So capital will be calculated as 30,000 divided by 10%, and the capital would be 300,000. And the capital would be 300,000. Now I need to calculate ROI. ROI means return on investment. ROI means return on investment. Return on investment. ROI. It is same like it is ROCE. Profit before interest and tax upon capital multiplied by 100. So what is my answer? PBIT. PBIT was 80,000. What's the capital? This is the capital figure. 300,000 multiplied by 100. So ROI is, it is 26.7, or we can say it is 27%, and my answer is D, 27%. 27% is ROI, and this is a complete examination standard question. I'm giving you 15 to 20 seconds window to copy or note down or taking the screenshot, whatever you want. Now, moving to the next points to be remembered. Yes, these are very important points. See that we are assessing the performance of a division. We are assessing the performance of a division. So we should take those figures which are under the control of a division. Which are under the control of a division. Okay, which are under the control of a division. Because it's a good rule to assess the performance. Performance should be assessed based on the controllable factors. Performance should be judged on the basis of controllable factors. because if something is out of my control, how can I be responsible for that? Okay. If selected the figures which are not controllable by the division, then division may be demotivated and poor motivation will impact the future performance. Yes, it does make sense. For example, there is inflation in the country and you are blaming me that, Sir Haris, you have purchased the material at expensive rates. I'm saying that it's not my fault. It's a general inflation applicable on the all commodities, and you are making me responsible. And even I am not responsible for that because it is the inflation element, which is something out of my control. So if you will be blaming me for some factors which are not under my control, obviously the performer would be demotivated, and the demotivation will definitely leave the impact on the future performance. So always take the controllable factors by the division because we are assessing the performance of a division. Now see here, it is a very good question. Space, no, first of all, read out the requirement. Calculate ROI, that is return on investment. And then we need to calculate RI. And then we need to calculate RI. RI means residual income. I'm going to read the question. Space is the division of Sky, a large manufacturing company having 3 divisions which control IT cost. A large manufacturing company, see, a large manufacturing company with 3 divisions controls IT cost for all of the divisions. That means, see that IT cost 25 is controlled by division. Sorry, it's controlled by head office. Sky is head office. It's controlled by head office. This IT cost is controlled by head office. It's controlled by head office. Okay. Now, see that there's a sale. Yes, it's a factor. Cost of sale, distribution expense, and this is written head office cost. This is head office cost, and these two costs should not be included while calculating the profit figure. And these are other operating expenses 13. So how will you calculate the profit for the division? That is profit controllable by division. Profit controllable by division, that is sales minus controlled cost. That is 190 minus 85 minus 15, because these all are the operational costs, minus 13. So 190 minus 85 minus 15 minus 13, that is $77. And 77 will be called as the profit controllable by the division. And capital is 385 million and cost of capital is 15 million. It is given. So simply calculate number 1, ROI. ROI, and this is 77 million. Okay. So ROI is calculated as PBIT upon capital multiplied by 100. What is PBIT? 77. Capital 385 multiplied by 100. 77 upon 385. That is 20%. Number 2, RI, that is residual income. And how to calculate RI? That is profit before interest and tax. 77 million less imputed interest. That's capital multiplied by cost of capital. Capital is 385 million multiplied by 15%. 385 into 15%, that is 57.75. And residual income is there, 19.25 million. So 20% and 19.25 million. Okay, students. Now let's move on to the next question, that is the next slide, that is the liquidity ratios. Liquidity ratios. Now first of all, uh, I need to explain the term liquidity. Liquidity means assessing the liquidity status. The liquidity status. Now what do you mean by the exactly mean by the term liquidity status? Liquidity status means liquidity is basically showing that how much current assets you have, how ability to have current assets. Liquidity status is basically showing the status of current assets. The status of current assets, that is a liquidity status. Liquidity is basically means that status of current assets and converting into cash. Liquidity is basically showing the cash or cash equivalent. Cash or cash equivalent. Now there is a ratio of current ratio, that is current asset upon current liabilities. What does this ratio means? You will be understanding this thing as well. Current ratio means that how much current assets are there to settle current liabilities. For example, if I can say that your current asset is let's say 120 and your current liability is let's say $85. So that means 120 upon 85, that is giving me 1.4. And how I will be writing 1.4 like that way, 1.4 colon $1, and $1 is basically showing current liability, and it is always constant, and 1.4 is showing current asset. That means to settle every $1 current liability, the company has 1.4 current assets, and ideally speaking, it should be 2 times. It is preferred that it should be 2 times. 1.4:1 ratio means, it means for every $1 current liability, the company is having $1.4 current assets, and 2:1 ratio is preferred. It is not preferred according to IAS or any accounting standard. It is a generally accepted practice that in a market that a 2:1 ratio is highly preferable in the market. It is not the accounting standards. And there is another which is a quick ratio, and there is another which is a quick or acid test ratio. And what is a quick and acid test ratio means that quick ratio is current asset minus inventory upon current liability, because excluding inventory. Why? Because inventory is something which is not easily converted into cash. Inventory is something which is not easily converted into cash. Inventory is something which is not easily converted into cash. So we need to have a very quick ratio, the fast ratio, excluding inventory. Why? Because inventory, for example, that I borrowed some money from you. For example, let's take a very common example here. I borrowed a money from you, and you are coming to me to recover your amount, and I'm saying that I do not have cash. Just take my calculator and go. You will be saying, sir, what do you mean by calculator or the furniture? What I will be doing with this inventory? How can I sell this inventory to in the market? So no one will accept as an alternate of cash to the inventory. So that is why inventory is excluded, because inventory is not easily converted into cash. So we need to exclude the inventory from current asset and current liability, and this is the fastest or the quickest ratio in order to assess the cash flow position of the organization. Okay, that is the status, that is the liquidity status of the organization. Now, moving to the next, as I have told you that current ratio should be more than 2 times. But this is a very good and important discussion which I'm going to make right now. What if what if what if current ratio is too much high? What if the current ratio is too much high? What is included in current assets? It's including receivables. It's including inventory. It's including cash. And yes, there is a prepayment as well, but the most common elements are these three. And in current liability, we have bank overdraft. We have bank overdraft. In the current liability, we have overdraft. We have payables. Okay. Now let's say, for example, the current assets are for example, okay, let's finally calculate the answer. Current asset upon current liability, and the answer is, let's say, 8. So that means 8:1. 8:1. That means what? That means you have $8 current assets. That means you have $8 current asset to settle $1 liability. That means you have too much current assets. That means you have current assets 8. That is too much. That is 8 times too much high. This is not high. This is too much high current assets. So what are the problem? What may be the problem? First of all, it is a good sign as well. Good sign as well. But when something exceeds the limit, it will be harmful. For example, everybody loves sweet dish, and if you will consume sweet dish more than your appetite, it will be converted to the disease, that is the sugar problem. Okay, so nothing should be too much increase. For example, you are having a lunch or a dinner. You like cheese, for example, but what if you will consume more than your appetite? There will be a digestion problem. So current asset is too much high, and too much anything, if anything will be too much high, it will be harmful. So the problem could be that number one was receivable. Imagine if receivable is too much high. So what would be the problems? So it can be bad debt. So there are late payment problems. Okay. Number two. Number two was inventory. Number two was inventory. See, if inventory is too much high, so there will be holding costs. Holding costs would increase. What if? Third one is the cash element. What if your cash is too much high? What if your cash is too much high? There are chances of theft. And one more problem, you miss out the investment opportunity. You miss out the investment opportunity. So what if the current ratio is too much high? Do not forget the other side of the point. That is the side effects of having very large amount of current assets and having a very increased current ratio. That is the current asset over current liability. So there are side effects as well if current ratio is too much high. And I've written those side effects. All of you, please come on to the question box. Is this theoretical portion understood by you? Have you learned something? Have you revised something? Please give the feedback up till now. Did you understand these points which I am explaining right now? Did you understand that which I have explained? Okay, that's good. Okay, that's good. Now, moving to the next. Moving to the next. slide. This is a working capital ratio. The working capital ratios. And what do you mean by the term working capital? It involves dealing with current assets and current liabilities. It involves dealing with current assets and current liabilities. That's the working capital. This is not a long-term capital. That's the working capital that you work in day-to-day activities. And working on day-to-day activities referring to the current assets and the current liabilities. But the net working capital is total assets minus total current liabilities. The amounted figure is your net working capital. Net working capital. And we have few working capital periods. We have working capital periods. And working capital is current assets and current liabilities. So the time period would be less than a year, less than or equal to a year. The time period could be 1 year, and you have to measure the time period. You have to measure that time period less than a year. That is based on less than a year period. That means it may be 365. That means days in a year, or it may be 12. That means months in a year, or it may be 52. That is weeks in a year. So it can be any period like 365, which means days, 12, which means months, 52, which means weeks. Number one time period is the inventory turnover period. Now, what do you mean by the term inventory turnover period? This is the average time period. See the word average time period in which inventory is converted into sale, and it is calculated as average inventory upon COGS multiplied by 365. That means they are measuring in the form of days. Average inventory upon COGS multiplied by 365. That means days. Okay. So that means, for example, if your answer is, let's say, 22 days, example, that means your stock is being sold after every 22 days, and that is the cycle. That means stock is sold, or I should use the word inventory. That's a good word. Inventory is sold in 22 days. That was a past assessment. And remember, note, this time period should be low. Obviously, I want that my inventory should be so. I will be preferring that my stock will be sold as soon as possible, because if this time period would increase, the holding cost would increase. This time period should be low. Point to be noted is that this day, I mean time, should be low. If this is high, then holding cost would increase. Then holding cost will increase. Inventory turnover period. Now, similarly, we have got receivable collection period. Now, what do you mean by the term receivable collection period? Receivable collection period means this is the average time period in which cash is received from the debtors, means receivables. Obviously, this should be low, because everybody wants that cash should be received as soon as possible. This time period should be low. Now I'm giving a warning sign that if this is high, if this time period is high, if this time period is high, then we will be having cash issue. We will be having cash issue, and probably we will be taking the loan, and probably we take loan which will increase interest and profit would be low. So that means interest would increase if we take the loan. So that means my profit would be reduced. So which means that receivable collection period, if increased, it will reduce your profitability. It will reduce your profitability. Now, that is the payable payment period in the next. Payable payment period should be high, but not too much high, because the supplier may be disappointed and will not give you credit in the future. But from the financial angle, the average time period in which cash is paid to the creditors. Creditors means suppliers. And you calculate this like average payables upon credit purchases multiplied by 365. If this time is high, that is, for example, we have to pay amounts to suppliers and we are not paying them on time. We are delaying it, for example. Then where is the cash? The cash is with me. If this time period is high, that means cash is in our hands. That means cash is in our hands and we can invest. If we can invest, so that means profit can be high. So increasing the payable payment period would increase the profitability. Yes, that would be the true statement. And if the receivable period would be increased, that means there would be a cash flow issue, and probably we take loan. And if you will be taking the loan, that means your interest would increase. Your interest would increase, which will reduce your profitability. Okay, and the resulting would be the lowering in the profit. So payable payment period should be high. Payable payment period should be high, because if you will be delaying to the suppliers, but not too much delay, you should also consider the relationship. You should also consider the relation with supplier. Not too much late payment, because if you will be paying to the suppliers late, they will not be giving you credit in the near future. So it may be possible that they may be disappointed. So you should be delaying the supplier payments in a reasonable time period. Now, working capital cycle. Now, working capital cycle. What is working capital cycle? Working capital cycle is basically it shows the time gap. It shows the time gap. It shows the time gap. Time gap of what? cash inflow and cash outflow. See that inventory turnover period, for example, inventory turnover period, for example, it is 5 days. For example, this is 15 days. So that means after 5 days, your inventory will be sold. And moreover, after that 15 days, the customer will be paying you. So that means your payment would be receiving after 20 days. So 20 days is the time period for the cash inflow. And let's say, for example, the payable payment period is, let's say, for example, it was 18 days. That means 2. That's a cash outflow. Cash outflow. So it means that the company is having a cash flow problem for 2 days because the, the settlement period to the supplier is 18 days and we are having our cash inflow in 20 days. That means we are having shortage of cash for 2 days, and it quite may be possible that it would increase our interest burden for the 2 days overdraft facility, for example. So we have to pay in 18 days, but we are receiving in 20 days. This working capital cycle should be low as possible. This cycle period should be low as possible. What I'm trying to say, that your cash inflow should be less than your cash outflow. That is a good indication. Cash inflow period if less than cash outflow, if less than cash outflow, so that means it's good, or at least it should be low as possible. It should be low as possible. It should not be too should not be too much high, this cycle period, because increasing the working capital cycle period, that means there are chances that your interest burden would increase. Now moving to the next gearing ratio. Moving to the next gearing ratios. What do you mean by the term gearing ratios? The word gearing shows the debt burden. Shows debt burden. It shows the debt burden, and that means long-term debt. Now there is a capital gearing, or you can also say that a leverage ratio. Capital gearing or leverage ratio. It shows the debt burden on the company, that is long-term debt upon long-term debt plus equity. How? For example, I have got 150 finance, 100 is mine, 100 is my own equity, and 50 I had received from a long-term liability. Then this is something which is a debt. So how I will be calculating? That is 50 over total 150, and 150 can also be shown as 50 plus 100. So that means I can say that 50 upon 150, 50 upon 150, that means I am having 33.3% debt burden. Debt burden on me. That is 33.3% debt burden. That is debt to debt plus equity. Because from the total 150, I have got 50 debts, and this is something debt, and this is equity. So the formula is applied over here, gearing ratio. Next is the interest cover ratio. Interest cover ratio, as its name implies, that interest cover ratio. That means profit over interest, that is column, not the percent. That is how much profit is available to settle each $1 interest. For example, if my PBIT is dollar, let's say for example it is 1600, and my interest amount is let's say 700. So that means 1600 upon 700, that is 2.29. 2.29. What does it mean? Yes, you are thinking same. That is 2.29 colon $1. And $1 is something which shows the denominator figure. That is interest. And that is profits. Means company has 2.29 PBIT to settle $1 interest. To settle $1 interest. And you know what? It's not a universal law, but generally 3:1 ratio is preferred. But generally speaking, a 3:1 ratio is preferred. That is the interest cover ratio. That can you cover your interest from the available profit? That is the main theme behind this interest cover ratio. Now students, we are taking a short break, and afterwards I will be starting this balance scorecard, but we are having a short break of 15 minutes from now, and I will be resuming at near about 1:05 p.m. approximately, before 1:10. Okay, so it's a short break, and as I have already told you that do not disconnect yourself, stay connected. I will be resuming after 15 minutes from now. Your break time starts now. Hello students, we are back from the break and I need a confirmation whether my screen and voice is all clear. Am I audible and my screen is all clear to all of you? Just give me a response so that I can resume with this lecture. Okay, that's good. Now, students, we are having our next topic. We are having our next topic, and the next topic is about the balance scorecard. The topic is about the balance scorecard. Now, what is the balance scorecard? It is a framework. Balance scorecard is a framework. That is a balance. Balance means it's a balance of financial and non-financial. It's a balance. It's a balance of financial and the non-financial with four different perspectives, including both financial and the non-financial. One, two, three, four. Remember, these are four KPIs. No, these are not four KPIs. These are four angles. Each angle is having different KPIs. Okay, each angle is having different KPIs. These are four perspectives. Each perspective, you will be receiving two things. Number one is the objective. Objective means yes, your target. And number two is measure. Measure means KPIs. And measure means KPIs, that means assess. That means assess. That means evaluate whether the objective is achieved or not. Whether the objective is achieved or not. Measure means KPI. That means assess, evaluate whether your objective is achieved or not. So these are not four KPIs. These are four perspectives. You can say there are four corners, and every corner has different KPI. Financial, customer, internal process efficiency, learning, innovation, and the growth perspective. Okay, so we have got four different perspectives. Number one is the financial. Now I'm going to explain the financial perspective. From the financial angle, what will be the objective of the organization? For example, if you are heading the organization, or if you are the owner of the organization, what will be your objective considering the financial aspect? What will be the objective of the company? My objective would be that I should have more cash, I should have more sales, I should have more money, more profits. These are my objectives. And what is the KPI? That means the measure. How will you measure that these objectives have been achieved or not? The simple answer is that through financial ratios. Through financial ratios. Yes, previous slides. Previous slides, which we had done. Through financial ratios, you can assess. Measure means you can assess. You can evaluate whether your financial motives, financial objectives have been achieved or not. Number one. Number two is that customer perspective. Now, what is the objective? This is not the objective of the customer. This is the objective of the company. This is the objective of the company from the customer perspective, that if I will be having the organization and I am the head of the organization, or if I am the head of the department, then from the customer perspective, my objective as a company would be that I should have more customers. I should have more customers. I will prefer my customers would be retained. That is repeat business from me. That is the repeat business from me. This is what I will be setting the objective from the customer perspective. More customers, more customer retention. I want more customer satisfaction. I want more customer satisfaction. And how will I assess? How will I measure? How will I assess? How will I assess? How will I analyze whether these objectives have been achieved or not? And remember one thing, whenever you are going to measure something, always calculate percentage. I have told you always calculate percentage, okay? So you need to calculate the percentage. How will you assess assess these things? Through percentage of complaints, you can assess whether the customer is happy or not. Through percentage of customer retention, through percentage of customer retention, through percentage of new customers, you can analyze this thing. Okay, so these are my KPIs. These are my KPIs in order to assess from the customer perspective. From the customer perspective, okay. Number three is the internal process efficiency perspective. Internal process efficiency perspective, and this is number 4, and number 3 I guess is missing, and I am going to write number 3 here, and I'm going to write number 3 perspective over here. Number 3 perspective is that internal process efficiency. Don't worry, I'm writing here internal process efficiency, and there are again 2 things. Number 1 is the objective. Objective is to maximize the strength and minimize the weakness. And how will you measure? How will you measure? That is the KPI. The KPI is that percentage of waste. That see something, internal process efficiency. That means something related to internal management. Number 3 perspective. So you can measure the percentage of waste. You can measure the percentage of idle time, and obviously you can measure through cost per unit. If your percentage of waste would be low, that means your cost per unit would be low. That means you are more efficient internally from your organization side. I'm waiting if you people want to note it down or to click the picture. Internal process efficiency perspective. Now, number 4 perspective is the learning, growth, innovation perspective. Learning, innovation, and growth. That is learning, innovation, and growth perspective. Now, what is the objective of the company? What is the objective of the company? My objective is that my staff should learn, my staff should innovate, and then growth of the company, and The objective is that after learning and innovation, the company will be in a position, the company will be in a position to launch new products. That is something the objective of the organization. And how will you measure? How will you measure? How will you measure the thing? You can measure the thing through the success rate of new products. Now, what is the success rate of new products? That is total sale of new products divided by total sale of company multiplied by 100. So that means you will be able to calculate the ratio, that is the percentage of revenue from the new services. And you can also calculate like that, that is the percentage of new products launched. New products launched. Something new. Learning and then innovate for the growth. Learning and then innovate for the growth. And you can also figure it out that how many of your staff members have learned the new things. There is percentage of staff learned. This can also be the case. So see that there are 4 perspectives in the balance scorecard. In the slide, the third was missing, and I wrote over here. And these are 4 perspectives. Point to be noted is that different KPIs contradict with each other. Yes, different KPIs contradict with each other. Now, I am giving you a very simple and a common example. Simple and easy example to understand the contradiction between the 2 perspectives and the 2 KPIs. Okay, simple is that. For example, there is an objective to launch new product. There's an objective to launch new product, and obviously we have to do research and development. Okay, research and development. It will take time. It will take time. In order to launch the new product, we have to do research and development, and it will take time. So that means your efficiency would be underrating. Why? Because efficiency, it will take more time. I should use the word, it will take more time. So that means your efficiency would be undermined. That is underrated. So there is a trade-off. If you want to improve one thing, the other aspect of the performance could be deteriorated. That is, if one thing is improved, contradiction means if one element is improved or if one element is good, then other element may be undermined. If one element is good, then other element may be undermined. Okay, so this is the note, and that is why it is recommended that to be effective, there should be limited number of KPIs so that there may less contradiction and that performance can be measured with ease. There should be limited number of KPIs which means number of KPIs should not be high, should not be low, it should be limited, so that you can easily compare the performance. You can easily compare or measure the performance. Okay. So that is why there should be a limited number of KPIs to be used so that performance can be measured with ease. Next, there is a question in MCQ format about the balance scorecard. Which of the following would be appropriate measure? Which of the following would be an appropriate measure? Measure means KPI. Measure means KPI. A company wants to measure the performance under the internal perspective. Can you answer? Can you people answer in the question box which is the correct option over here? From the internal perspective. Internal means looking at the management working. Looking at the management working. That means management strengths and management weaknesses. Can you people answer here, students? Yes, very good, excellent. This is labor capacity ratio. This is the financial. This would be the customer. This would be the learning and growth. Etc. Learning growth. And yes, this is the internal. So this is the correct option. Now I'm going towards the next slide in which you will be receiving one more question. And this is the very good question. Select all that apply. Select all that apply. Which of the following key performance indicator? Key performance indicator, that means measure. That means KPIs would be appropriate to assess the customer perspective with a traditional balanced scorecard. Select all that apply. Come on, give it a try, students. Give it a try to this question and drop your answer in the question box. Okay, so select all that apply from the customer perspective. Yes, that is B and C. That is the profitability analysis. That is the financial. Customer order processing time. Order processing time, that is the internal perspective. That is the internal perspective. B and C are the customer retention and customer satisfaction. Yes, These two answers are from the customer perspective. So our option is B and C. Our option is B and C. 2 and 3, yes. That's very good, Fiona Krish. Now, this was a model of balanced scorecard in order to evaluate the performance. Now we have another model. We have another model, and it has got 6 dimensions. It has got 6 dimensions. These are not 6 KPIs. Remember the word. These are not 6 KPIs. These are 6 dimensions. These are 6 what? These are 6 dimensions. These are 6 dimensions. And what are the 6 dimensions? Number 1, number 2, number 3, 4, 5, and number 6. There's a performance measurement in service business. Now, what is service business? Like, what's a service organization? Like you can say hospital. Like you can say banks, insurance companies. And there are different KPIs. Number 1 is the financial. Financial is the perspective. In balance score, there are 4 angles. In this framework, there are 6 angles. Now, the perspective of financial could be measured through the financial ratios. Now, the financial ratios are, yes, you can refer the previous slides. That is gross profit margin, net profit margin, etc., etc. These are the financial perspective. Number 2 is the competitive perspective. Competitive. What do you mean by the term competitiveness? Competitiveness means how well you are performing against competitor. That means how well you are performing against competitors. And C, this is not the manufacturing business, this is a service organization. And in service organization, the competitiveness can be measured through market share, through percentage of market share. For example, there are 1,000 customers of a particular service in my area, and we do provide the internet service. And from 1,000 users, I have got 200 customers. That means I have 20% market share. 20% market share. For example, there are 30 companies in your city, and we are having a bank, and we are having 15 customers are corporate clients. So that means we are having 50% market share. So competitiveness can be measured to the market share. That means number of customers. Okay. Number 3 is the quality. Number 3 is the quality. What is the quality? Quality is something which satisfies customer. Quality does not mean that the thing is expensive, then it should be of high quality. No, it's something which is up to the standard, up to the expectation of the customer. That means that product or service is of a good quality. And how will you measure your quality? Come on, how will you measure your quality? Your quality is being measured through percentage of complaints. The quality is measured through percentage of good feedbacks. For example, from 100 customers, you receive 80% good feedback. 80 customers, so that means your performance, your users are satisfied with your quality of services. Quality of services. Okay, let's satisfy the customer, let's satisfy the users. So that is the quality of services. Flexibility. What do you mean by the term flexibility? Flexibility means adapting the change. Adapting the what? change. You have to modify. See, there is a difference between flexibility and innovation. Flexibility is something coping up with the change. I can give you a very common example, very common and a simple example. Due to this pandemic, COVID-19 pandemic situation, the exam centers have been suspended for a short time period, somewhere in a long time period. Now, what is the flexibility which ACCA is doing? ACCA is facilitating for the remote invigilation. So that is the flexibility, adapting the change. According to the changing requirements, you should be able to change your services. You should be able to bring flexibility in your services. Okay, but the quality should not be compromised. It's a flexibility. And how will you measure the flexibility? You can measure the flexibility like, for example, number of times flexible. How many number of times you were flexible? How many number of times you were flexible? It cannot be. It can also be measured through time per job. Time per job. That is according to the given scenario. My time should be flexible. I'm giving a very simple example based on my teaching service. See, flexibility. When I do teach in a normal fresh class, it took me time to deliver my lecture. But this is not the fresh lecture. This is a crash lecture. This is a practice to pass lecture. I have to modify my lectures accordingly. Then I will be taking less time to deliver all the concepts. So what I did, I made the presentation. I selected the question like that way so that I can cover maximum portion of the course. So that is the flexibility. That is the flexibility that according to the time availability, I should modify myself, modify your services according to the given scenario. Okay. So yes, I am. Me, Haris Hanif as a tutor is a flexible. Why? Because according to the given scenario, I do modify my lecture. But the objective should not be compromised. I should deliver the complete lecture, but I should take minimum time or the maximum time based on the time availability to me. That is a flexibility. Next, innovation. What do you mean by the term innovation? Innovation is something new. And how will you measure something new? That is success rate of new services. Success rate of the new services, okay? And you also know that what's the innovation we had covered in the balanced scorecard. Next is the resource utilization. Now, what are the resources? The resources are human resource. The resources are machines. The resources are rooms. For example, we are teaching in our college, that is Tabani's School of Accountancy, TSA. And we have got many rooms. And how will I utilize those rooms? How will I utilize my machines? How will I utilize my human resources? That is the resource utilization. And you can measure the resource utilization through efficiency time, you can use capacity time, capacity ratio, you can use sales per staff, that how much money one staff is bringing to the organization. That is utilization of the available resources, and the utilization should be optimal utilization. Optimal utilization, that is the best use. That is the best use of the available resources. Best use of the available resources, okay? So that is the resource utilization means. Now, point to be noted is that number one, financial, and number two, competitiveness. These are the results of the efforts made in the past. And 3, 4, 5, and 6. These are these determines the future success. Why? Because if you will be performing well in these 4 areas, if you will be performing well if performing well in these areas now, that will be giving me the success in the future, giving the success in the future. Obviously, if I will be providing my services of good quality, good flexibility, with innovation, with resource utilization best, if I will be performing best today, my success will be waiting in the future. And what is the success in the future? The success is the more customers and more money, financial. So that means these two perspectives are the results of the efforts made in the past, and you have to perform well today now. If you are performing well today now, you will be having a success in the future. So remember these two statements as well. And I'm giving you 10 seconds window in order to focus on these two statements. And I will be proceeding for the next slide. Okay, students. Now, here is the question. And see that what had been written here. Which two? You have to take only two statements. Which two of the following would be the suitable measure? Measure means KPI of resource utilization for a private sector college. For a private sector college, think that you have studied in your school, in your institute, in your colleges. So what is the best utilization? What is the best utilization? Best utilization, resource utilization. Yes, number one is the average class size. Average class size. I'm giving you a very common example. For example, let's say there is room number one and there is a capacity of 60 students, for example. And there is room number three, there is a capacity of 50 students. No, I should reduce it. There is a capacity of 30 students. And if I am having 20 students batch, I should allot room number three because this is the best utilization. And obviously in room number one, where the capacity is high, there will be more consumption of the electricity. There will be three ACs, air conditioner, there will be more electricity bill. So the best utilization based on the less number of students, you should allot the room having the least capacity or the capacity which is being matched to the number of available students. So yes, this is the best utilization of your resources. For example, there are 40 students in a class, and I cannot allocate the auditorium where the capacity is of 200 students. There's the average class size, and you have to allot the room accordingly. That is the best utilization. Okay, that is the best utilization of the resources. So I am writing the statement here. There is an average class size. That means allot the room of class based on the number of students. Yes, it does make sense. That is the resource utilization. Tutor grading by students is not the resource utilization. Pass rates is not the resource utilization. Yes, percentage of room occupancy. Yes, this is the resource utilization. That how many rooms are occupied. How many rooms are occupied? That is the resource utilization. Resource utilization. Because we are using the resources. Classroom is the resource. Room is the resource, and we are using the rooms. We are using rooms, so that means the resource utilization. Okay, so there's one and two, and the question was asking for the two things. Now, next question. Next question is that which two of the following performance indicators? Which two of the following performance indicators? Performance indicators, that means KPI, could be used to measure quality of service. That's the quality of service. Yes, A and B, because number of customer complaints, it depends on the quality. Customer retention, yes, it's a quality. Imagine if the customer is happy with the quality you are providing, there will be less complaint. If you are providing a good quality service, the customers will be retained. Okay, and overtime and number of six are not. These two are the qualitative aspects to measure the performance. That's the quality. That is the quality. Now we have another model. Yes, value for money. Value value means benefit for money. Money means that's the amount which you are spending. I'm giving you a very common example. For example, you have $100,000 and you have purchased a machine. For example, you have purchased a machine and it is in the room which is unused for the past 3 months. You have purchased a machine worth $100,000 and you are not using that machine. That means there is no benefit from that money which you had invested or you have spent. If no benefit, there is no value for that money. That means use your money, use your amounts, use your money which give you the benefit, and it is mainly used for the public sector and not for profit organization. Now what is the public sector? Public sector, it is the government controlled organization. For example, the airport in your country, in your city, that is not under control of the private individual, that is under the control of the government, and that is known as the public sector. Public sector. And VFM includes three things: economy, efficiency, and the effectiveness. Now, there are three parameters of economy, efficiency, and the effectiveness. What do you mean by the term economy? Economy involves that input of the resources. Input means purchasing of the resources that should be at the lowest price, but quality and quantity should not be compromised. For example, I'm giving the example that public sector and not-for-profit organization. Not-for-profit organization are being run on donations, and the government bodies are being run through the taxes of the public. People are paying taxes, and the government organizations are in operation. Okay, so we have to consider the value for money because the money is being taken from the public in the form of the donations and in the form of the taxes. I just look at the question. Mr. Saad Ahmed, is your query addressed? That why not option B? Mr. Saad Ahmed, as I have explained all the things. Mr. Saad Ahmed, is your query addressed? About you raise a question of why number D. Of this specific question you are asking about? Okay. See, this question was about the quality aspect, and this is a number of sick days. That is a number of sick days means um, number of sick days, staff absent due to the health problem. So it is nothing to do with the quality. If the staff is not feeling well, they can simply take off and come back when they are recovered from the disease. So that's nothing to do with the quality. The quality is something refers to the customer perspective. That is why, okay? Okay, that's good. Okay, students, now resuming back to the value for money. I was saying that value for money means the benefit which you are obtaining from the money, and the money is in the form of the donations and the taxes. Now, economy. What do you mean by the term economy? That means purchasing of the resources at the lowest price, because it's not my money, it is the public which I have collected from the donations of the from the public. So I should be purchasing the things at the lowest price. Number two, efficiency. What is efficiency? Efficiency means, the word efficiency means processing. Processing means use of resources. I should use the resources. It involves use of available resources less on per unit. My resources should be less on per unit, and thereafter I can obtain more output from the resources available. So you need to, for example, time on per unit. If time on per unit is low, that means more output, and that means you are more efficient. For example, I'm solving an assignment in 3 hours, and later on I'm solving the particular assignment in 2.5 hours. My efficiency would be increased. That is the efficiency. Number 3 is the effectiveness. Effectiveness means what? It measures whether your target output was achieved or not. Your target output, your desired output was achieved or not. Your target output. For example, the hospital. Why the hospital has been opened? The main purpose of the hospital is to recover the patients. And what is the recovery rate? That is your target output, and you are analyzing whether your target output is achieved or not. Okay. Now, very good question. Very good question. Classify the following. Either you have to just check where these statements are falling. Number 1. Have the waiting list been reduced? Waiting list for the hospital. Imagine if the waiting list would be reduced, that means we are heading towards our objective to deal with the patients. That is the effectiveness. Number 2, what was the average cost per patient? Average cost per patient. This is efficiency. Why? If your time per unit is low, you are having more output. If your time per unit is low, you can also see that use of resources. If waste is low, that means your cost per unit will also be low. So cost per unit is a measure of efficiency. Cost per unit is a measure of efficiency. If your wastage rate is lower than your estimated, then obviously your cost per unit will also be low. So that is why it is efficiency. Number 3, have the mortality rates gone down? Mortality rates, death rates gone down. It is effectiveness. Why? Because the main objective of the hospital is to reduce the death rate and increase the recovery rate. So it is the measure of effectiveness. Next, did the hospital spend more or less on the drugs this year? These are medicines, and medicines are purchased When it will come to the usage on the patient, that will be shifting towards the efficiency. But when it is purchase and the purchase cost, that is economy. Purchase cost means economy. That is a purchasing. When you will be using, that will be from the efficiency perspective. Next, what was the average spent per bed? Average spent per bed over the period. That is again cost per bed. That is cost per unit, and that is the efficiency. Anything which is being measured on per unit is the efficiency. And the last, did the hospital spend more or less on nurse wages? See, you are acquiring HR services. HR services. The nurse wages economy, because it is usually written in the government-based hospital that staff are needed on voluntary basis. That is the input of the workers. That is the input of the workers. Okay, that is the input of the workers. So it is economy. Next, there's a next question, and here you go. Question. I think you people should read the question now. Read the question now. Hurry up. I'm giving you 1 to 2 minutes to read this question. Then I will be explaining and solving this question. Okay, students. Now I'm going to read this question, and I'm going to um, mark on the things. That company provides accounting services to the government On average, each staff member works 6 chargeable hours per day, with the rest of their working days spent on the non-chargeable administrative time and whatever. I'm now reading these three requirements, three statements. Number one, cutting the departmental expenditure by 5%. Cutting the departmental expense, that means your input, that means your input cost is reduced by 5%. That comes under economy. Target number one is economy. Target number one is economy. Number two, increasing the number of chargeable hours handled by advisors to 6.2 per day. 6.2 per day. Chargeable hours handled by the advisors to 6.2 per day. That is 6 hours per day, and this is 6.2 hours per day. When something is being measured on something per unit or whatever, this is the efficiency. And obtaining a score, see, obtaining a score of 4.7 on a customer satisfaction, this is the output and this is the effectiveness. This is the output and this is the effectiveness. My main focus and the agenda was that I should cover the maximum portion of performance measurement, and alhamdulillah we had covered majority of the areas of the performance measurement. Now students, I am now giving you an assignment. Let's make this webinar more interesting. I can increase 10 minutes for this webinar to cover this OTQ. That's GoGo Limited is a manufacturing company. See, 2 marks, 2 marks, and 2 marks. 6, 7, 8, 9, 10. This was total 10 marks. The handout is already uploaded here, and I have also shared that handout in a WhatsApp group. And this is my WhatsApp number. I'm just mentioning it again. You can and the group link has also been shared. The group link has also been shared in the question box. But we are running out of time, so I think we should be time oriented. But don't you people worry. I will be solving this question tomorrow. I will be solving this question tomorrow with the same level of explanation which I am making. But I encourage all of you just to solve these OTQ, case-based OTQ by yourself. This is your test, your understanding. And don't you worry, Mr. Saad, I will be explaining with the same level of quality, inshallah, tomorrow. Okay, students, just come on to the question box. Was this session of today helpful? Had you learned something or had you revised something? Come on, waiting for your feedback. Waiting for your feedback. Because as I've mentioned, it's a two-way communication. Okay, that's very good. And I appreciated your feedbacks, but must try this OTQ, and I will be explaining this OTQ in tomorrow class with our tomorrow agenda of other areas. Okay, so till here the webinar is going to end soon. Take care of yourself. Bye.